Hi, and welcome to this online professional Forex trading course. I'm Adam Koo, and in this course, you're going to be learning the exact skills and strategies of how to trade Forex consistently, how to achieve consistent profits, and create another source of income for yourself. And I can tell you that if you are committed to master these skills and to apply and to practice, you're going to be trading like a professional in a short period of time. And you can create another source of income for yourself to better your lifestyle or eventually use it to replace your day job. So if you know nothing about Forex, let's begin with lesson 1, which is the introduction to Forex trading. So what is Forex? I'm sure you've heard of it in the news or through friends. And basically Forex is foreign exchange or FX, right? And the FX market is one in which a nation's currency is traded of that at another at a mutually agreed rate. The Forex market is run electronically within a network of banks, so there's no exact stock exchange, right? It's run via the bank network, and it's 24 hours, 5 days a week. It's the largest market in the world. So if you compare it with the stock market, the total value of the stock market is about $500 billion. In comparison, for Forex, it's 3 trillion a day. Okay, so it's the biggest market in the world. And the way I trade Forex is I treat it like any other business, right? So in any business, how do you make money? You make money by buying something and selling it at a higher price. Okay, for example, if you own a restaurant, you're buying ingredients at a lower price, you're buying people's time to cook the meals, and you're selling it at a higher price on the menu. That's how you make money. Or in business, sometimes you can sell to your customer first at a higher price and manufacture it at a lower price and deliver the goods, right? That happens in any business. Now, it's no difference in a Forex trading business. The only difference is you're buying and selling not physical products, you're buying and selling currencies, okay? And it's one of the best businesses you can get into for a few reasons. Number one, minimal investment. So if you start any other business, a restaurant, a shop, it's going to take a few $100,000 just to get started. Okay, but in the business of Forex trading, you can start as little as $200 US, which is a mini trading account. Okay, I can say that most people start with a few thousand, but again, you can even start with $200. Next, minimal time commitment. Right? In any other business, especially if you're a startup, forget about going back to your family, forget about work-life balance. You're working 15 to 16 hours a day. You're doing everything, right? But when you trade Forex, even as a beginner, you don't need more than 3 to 6 hours a day to be really, really successful and to succeed in this business. Next, you don't have to worry about overheads like any other business. There's no employees, there's no office rental to worry about, there's no inventory costs. Okay? Next thing is recession proof. The main thing that kills people or kills businesses are bad times, recession, people are not spending money, right? In the business of Forex trading, there is no good and bad time, right? Why? Because we make money regardless of the direction of currency pairs, right? If the market goes up, currency goes up, we go long on a certain currency pair. If the currency pair goes down, we go short, which is to sell. So either way, we're making money regardless of the economic situation. So it is totally non-correlated to the stock market. So if you're someone who's already trading stocks like I am and investing in stocks, and you want to have another avenue to generate income that's not correlated, Forex is a perfect business to get into. Right? In other words, you can make money in both these markets successfully. Next, to succeed, you must be willing to work hard and master this skill. I keep telling people that, is trading easy? Well, it's like asking the same question, is business easy? Is are relationships easy? Is maintaining good health easy? Of course not, because if any of these things were easy, everyone would be a multi-millionaire, would own $1 billion company, and would be having a six-pack set of abs. All right, it's not easy. Right? If it was easy, nobody in the world would work. Okay, everyone will stay at home and make money by pressing a button on your computer screen. It's not easy, right? And it's good it's not easy, because if it's easy, everyone will do it, and there's no money left. Okay, in fact, it's not easy, right? There's no free lunch in this world. No one gives you free money. So the business of Forex trading is like any other business, like any other career, in a way that you need skills, you need knowledge. right? A lot of people, they go into trading without skills and knowledge, and that's akin to gambling, right? So when they make money, it's based on luck, and they lose money, it's because of my bad luck, and that's not sustainable because anyone can make money in the markets, anyone, any idiot, and it's called luck. But can you keep that money? Can you do it consistently? Now that is not about luck, that's about skill. So that's the main difference. So I need to understand that yes, the skill of forex trading is like any other skill that you learn in any other profession, whether you're a lawyer, a doctor, or an engineer. It takes time to hone these skills. But the good thing is that in trading, it takes less time relative to other professions, like being a medical doctor and doing surgery. It takes less time relatively, but it still takes time nonetheless. And I can tell you that from my experience, even with the best coach and the best training, it'll probably take you at least 6 months to 12 months to truly master these skills if you work really hard. Okay, I know people who have taken 3 to 4 years to master the skill, right? Maybe they didn't spend as much time every day, or they kind of like were half-hearted. But if you're truly committed, I can tell you 6 months to 1 year, you can do this professionally with what you're going to learn in this course. Because by taking this course, you've just cut short your learning curve tremendously by more than 90%. I always tell people that could you do this yourself? Could you learn Forex yourself without attending a course? And the answer is of course, you could do it yourself through trial and error. I can tell you that it's not going to take you a year or 4 years. It'll probably take you over 10 years. I've known people who have been trading for more than 10 to 12 years and not making any money consistently. They make the money, they lose it back again because they're going around in circles making the same stupid mistakes. So the purpose of this course is to really help you to cut short your learning curve. So what you've invested in this course, I can tell you, you've just bought 10 years of your life compressed to a couple of hours if you learn this course in a condensed fashion, right? So you got to work hard, you got to practice, you're going to have a skill that's going to guarantee you an income for the rest of your life. I can tell you that. I tell people nowadays that, we go to school, we learn skills like engineering and accountancy and programming, and these skills are great, but they can't guarantee us a job in 5 to 10 years because we can be replaced by someone else with the same skills, someone eventually younger, cheaper, and faster. And when you work in a company, the more senior you are, the more you get promoted, the more expensive you are to be kept. And eventually, you can get retrenched, right, or get a pay cut. But when you master the skill of trading, whether it's a forex trading or stock trading, it's a skill that can guarantee you an income for the rest of your life. All you need is a laptop, an internet connection, the skills, that's it. Right, you're set for life. So I hope you're excited to master the skill. All right, so the next benefit of trading Forex is that it's a 24-hour market, so it's extremely flexible. You can trade anytime during the day, right? And so you can build your business from anywhere in the world at whatever time zone. And in fact, you can plan your daily routine around your day job. So you can keep your day job and trade Forex outside your working hours. No worries. So this gives you an overview of when the different Forex markets are active. And remember, Forex is run electronically via banks, right? So there's no central exchange, if you will, right? So different banks around the world kind of get active at different parts of the day. So what you're looking at here is actually my time, which is Singapore local time, okay? So if you're looking at New York time, which is Eastern Standard Time, with daylight savings, it's kind of like the reverse. So in other words, Singapore 1 a.m. would be PM for Eastern Standard Time. Eastern Standard Time, that would be New York time. Okay? And again, 1 p.m. Singapore time would be AM Eastern Standard Time. So just flip it around if you are in the Eastern Standard Time zone. Okay? All right. So what happens is, I'm going to talk in terms of Singapore time, so just flip it around. At 6 a.m. Singapore time, the Australians start trading. All right, Australian market opens, Sydney opens, so they start trading from 6 a.m. to 2 p.m. So that's when the Aussie dollar, Australian dollar starts getting active, because that's when the Aussies are trading, okay? And at 8 a.m., you find that the Tokyo market opens and Tokyo banks start trading. So that's when the Japanese yen starts getting active, all the way from 8 a.m. to 4 p.m., okay? Now, so that's again when the Japanese yen gets active. At 4 p.m. Singapore time, which is again 4 a.m. Eastern Standard Time, the London market opens. So the euro, the pound, right? These start getting active in trading all the way to 12 midnight Singapore time, which is 12 p.m. Eastern Standard Time. And the US, New York to be exact, starts at, again, obviously 9 a.m. New York time, which is 9 p.m. Singapore time, all the way to 5 a.m. Singapore time. That's when the US market starts getting active, right? And the US dollar starts getting really active. So most people who trade the very liquid currency pairs like the Euro USD, okay, they will start looking at the markets usually from 4 p.m. Singapore time onwards. That's when it starts getting active. If you're trading the Japanese yen or the Australian dollar, you can start, of course, a lot earlier. All right. Next, the business of Forex trading allows you to generate consistent profits once you master this skill. Okay. So profit returns of 5% to 20% a month are very possible. In fact, that's pretty common among successful Forex traders. Now, some of you may think, but currencies don't move 5 to 20% a month. So how do you make 5 to 20% a month? And the answer is through leverage. The currency market allows you to leverage. And what it means is that you can buy, $1 million or million US dollars worth of currency without having $1 million US dollars, right? In fact, you just need less than 1% of cash in order to take $1 million position. So even if the price of the US dollar moves by just a bit, like moves by 0.001%, that equates to even a 10% return on your investment because of the leverage factor, okay? So for a $100,000 account, for example, you can easily generate 5 to 20 grand a month in profits. Again, when I say easily, means you have mastered the skill, okay? Now, you don't have to start with 100,000, obviously. Like I said, you can start with $1,000, you can start with $200, but understand that you are then getting 5 to 20% returns off that $1,000 or off that $200, okay? And I know some of you are thinking, hey, Adam, I've seen videos of, I watch ads where people say, I'm making 100% a month, 500% a month in Forex. Why are you making only 5% or 20%, right? That's not exciting. Well, sure. Are there people who make 100%, 200% a month in Forex? Yes, they are. They are. And I can tell you this. They don't do that every month. Okay? And I can tell you most of the people who are making 100%, 200% a month are taking extremely high risks. And what they don't tell you is that a month later or the next month, they lose everything. Okay? So if you want to make, get a big bang, sure, go do that. Go risk a lot and you can make a lot in a short period of time. But more often than not, it is not sustainable. Like I said, making money in the financial markets is very easy. An idiot can do it. It's called luck. Just being there at the right place at the right time. Remember, the market can either go up or go down. So you've got a 50-50 chance of being right when you place a bet. Okay? But it is being able to keep that money and to do it consistently like a regular income source, that's difficult. And if you want to do that, you cannot risk a large amount of your capital because all you need is one time you're wrong, and you will be wrong because it's a 50-50 chance in the short term, you're going to wipe everything out. And that's why most people who don't understand this, most people who go into trading with this grandiose thing that I'm going to become a millionaire overnight, 99.9% they will lose everything. All right. So I can tell you that most people who do not take a proper course and they go in there and they try this out, they will tend to blow their account. Blow their account means they're going to lose everything at least 3 to 4 times before they wake up and say, okay, fine, now I'm going to do it properly. And doing it properly means not wanting to get 100%, 200% return a month because that's not sustainable. Okay, it's getting 5%, 20% a month. That's sustainable. All right, and it's better to do that consistently month after month after month, then 100%, 200% one month and blow everything the next month. Make sense? I hope you agree, right? And that's really important. Okay, good. Let's move on. Forex basics. Okay, if you know nothing about Forex, understand that Forex is quoted always in currency pairs. Okay, so it's unlike the stock market. In stock market, you ask, what's the price of Facebook? Facebook's $160. That's it. That's one stock. But in currency, you can't ask what is the price of the US dollar. No, the price of the US dollar versus what? Versus the euro, versus the yen. So currency is always quoted in pairs, right? One currency being exchanged for another currency, okay? And each currency is given a 3-letter code. So this is something that you have to memorize, okay? EUR is the euro, USD is the US dollar, GBP is the Great British Pound, JPY Japanese yen, CHF is the Swiss franc, AUD the Australian dollar, CAD Canadian dollar, and NZD the New Zealand dollar. So these are the 8 most common currency symbols that we will be trading. We won't be trading Zimbabwe dollars or Singapore dollars. No, that's too exotic, all right? Main currency pairs. So again, these are other currency symbols that we won't be trading, right? At least I don't trade them. And again, the most successful traders only trade the most common and liquid 7 pairs. Now, I do trade beyond the 7 pairs, slightly beyond it. I'm going to show it to you, but these are the 7 most common pairs, which are the most liquid. They're the most actively traded, okay, highest volume. So it moves with the greatest volatility and the tightest spreads. And I'll talk about spreads in a while. So what are the 7 most common pairs? You've got the Euro USD, or you call it the Euro dollar. We've got the pound dollar. We've got the dollar yen, which is US dollar versus Japanese yen. Dollar franc. We have the Aussie dollar, New Zealand dollar, and the dollar CAD. Okay, so these are the 7 most common pairs. So how do you read a currency quote? Again, currencies are quoted in pairs and mostly in 4 decimal places. So what you see here is Euro USD 1.35052. Okay. Now, we only pay attention to the 4 decimal places. Okay, the 5th decimal place is known as a fractional pip, and we do not care about that. Okay, so it's too small to worry about. We're looking at the 4 decimal places, right? So the last decimal place represents a pip, and I'll talk about that in a short while. Okay, so when you see a currency pair, the first one is known as the base currency. So Euro is the base currency. USD is known as the quote currency. All right. And like I said, the 4th decimal place is known as the pip. And the pip is the smallest change in the currency pair that we are concerned about. Okay. So in this case, it is 3505. Now, usually when we read it, we don't go 1.3505. We just say 3505. Okay. Now, if it goes from 3505 to 3506, what does it mean? It means that the euro has, or rather the euro USD has gone up by 1 pip, right? Because from 5 to 6, it's 1 pip. Does that make sense? Okay. Now, if it goes 3505 to 3516, what has happened? The euro USD has gone up by 11 pips. Does that make sense? 11 pips. Because 11 plus 5 is 16. Okay? So pip is the last decimal place. So if you look at this entire thing, it's 3,505 pips since it moved up from 0, okay, which was a damn long time ago. Like I mentioned, it's a fractional pip, so we're not going to worry about that. We're going to look at the pip, okay? So like I said, the base currency always has a value of 1, okay? So in this case, euro, we're saying 1 euro. So in this case, what we're saying is that 1 euro is equivalent to 1.3505 US dollars at this particular point in time. So in other words, if you want to buy €1, you have to pay $1.3505 US dollars to buy €1. And if you want to sell €1, you would receive 1.3505 US dollars. So that's how you read currency quote. Okay. Now, understand that all currency pairs, except the ones with Japanese yen in them, are always quoted to 4 decimal places. Okay. So 1 pip is 0.0001. Okay, so that's 1 pip, which I mentioned earlier on. But anytime you've got a Japanese yen in the pair, like you've got dollar yen, you've got pound yen, right? Anything with a yen, okay, the pairs are always quoted to 2 decimal places. So whenever you have a yen, 1 pip is the second decimal place. Second decimal place for any of the yen pairs. So the best example is the US yen or the dollar yen. So in this case, the dollar yen is 98.73 or 98.73. So again, what is this called? Right, the first currency in the quote is the base currency. Right, remember this is the base currency. Let me write down. This is the base currency. And what is this called, ladies and gentlemen? It's called the quote currency. That's right. So remember that the base currency, which is the first one, is always 1. Okay, it's always 1. So what we're saying now is that $1 is equivalent to 98.73 Japanese yen. Okay, and again, this 3, the second decimal place, is a pip. So if it goes from 9873 to 9874, right, the dollar yen has gone up by 1 pip. Make sense? Right? If it goes from 9873 to 9884, it's gone up by 11 pips. Okay? If it goes from 9873 to 9872, it's gone down by 1 pip. Right? So you got that? Okay. So in other words, again, right, $1 is equivalent to 98.73 Japanese yen. So again, what's a pip? A pip is known as a price interest point. It's the smallest change in value for any given forex quote that we're interested in. Of course, the smallest one is the fractional pip, but we don't care about that. So it's the smallest one we care about. Okay. So once again, for all non-yen forex pairs, 1 pip represents the 4th decimal place of the quote. Okay, so again, when the Euro USD moves from 3505 to 3506, it's a movement of 1 pip or 0.0001. Okay, for yen forex pairs, 1 pip represents the 2nd decimal place of the quote. When the dollar yen moves from 80.55 to 80.87, it's a movement of 32 pips. Right, just reiterating what I just said. Right, so I hope you understand. You're clear at this point in time. Alright, so the next thing to understand is contract lot sizes. So in the forex markets, when you buy or you sell, you're buying units of currency, right, in lots. So one standard lot that you buy is always 100,000 of the base currency. So if you buy 1 lot of Euro USD, you're actually buying 100,000 euros. If you buy 1 lot of dollar franc, you're buying 100,000 US dollars. Okay, so it goes by lots. And again, 1 pip is the 4th decimal place for non-yen pairs, and for yen pairs like dollar yen, pound yen, is the 2nd decimal place. So just remember, one standard lot is 100,000 of the base currency. Now, you don't have to buy 1 lot. You can buy less than 1 lot. Okay. So, like I said, a standard lot is 100,000 of the base currency. And you don't have to buy 1 lot. You can buy a mini lot, 10,000, micro lot, 1,000, a nano lot, 100. Okay. Now you don't have to remember the names of these. It's not important. What's important is to know how many units you have to buy and how do you key in the lot size. Now it depends on the broker you use. For example, if you use most MT4 platforms, you key in terms of lot size. For example, If you want to buy 100,000 euros, okay, for Euro USD, then you key in 1, right? Because 1 means one lot means 100,000, okay? If you want to buy 50,000, what do you key in? You key in 0.5, okay? 0.5, because one lot is 100,000, so 0.5 is 50,000. Okay, let me just write it down for you. So one lot is 100,000. 1, 2, 3, and 0.5 is 50,000. 1, 2, 3. Okay, so let me repeat. If you're trading with most brokers that use an MT4 platform, then you key in 1 for 100,000, 0.5 for 50,000. If you're going to buy 500,000, then you key in 5. Does it make sense? Okay. But there are certain brokers, for example, if you trade with interactive brokers, when you key in, you don't key in by lot size, you key in by the currency unit. So in other words, for interactive brokers, you key in 100,000, right? You key in 100,000, not 1, because if you key in 1, they just buy $1 US, okay? So you have to key in 100,000. So you have to know the broker you're using. You key in lot size on the left, or you key in the number of units, right? That's really important. But like I said, for most MT4 brokers that you'll be using, you key in by lot size, all right? Next, how do you calculate Forex profits? So the profit you make or the loss you make is equal to the number of pips that you capture, okay? It moved by 20 pips. It moved by 100 pips. So how many pips did you capture? Multiplied by the number of lots, multiplied by the dollar value per pip per standard lot. Okay, so you understand the number of pips, right? 20 pips, 100 pips, right? You understand the number of lots, right? So one lot, 100,000, two lots, 200,000. Okay, you understand that. Now, what is the meaning of the dollar value per pip? In other words, how much is one pip worth per standard lot? Okay, and the answer is this. The dollar value per pip for each standard lot is usually about $10, okay, for most of the actively traded pairs like Euro USD, Pound USD, and Aussie USD, okay. But to get the exact value, you can go to this website over here, which is mtpredictor.com/pip value table to find out the exact dollar value per pip per lot for most of the major currency pairs. So if you go to the website, you will see something like that, okay? And again, this changes all the time. So you have to get the latest update on that day, okay? So on this day, when I log in, it's the 7th of October. So as of the 7th of October, you can see that for Euro USD, the value of one pip is, now, this table is based on a mini lot of 10,000. Okay, so we want to look at a standard lot, which is 100,000, right? Which I talked about. So, in other words, you have to take this multiplied by 10 to get a standard lot. Okay, so 1 times 10 is $10, right? So all this would be $10. Okay, this would be $8.90, right? And this would be this would be $10.20, right? Just multiply by 10. You understand? Euro franc, this would be $10.20. This will be $8.90. So you can see that for most of the currency pairs, it is straight up $10. All right. So in other words, every 1 pip movement is $10 per lot that you buy. That's what it means. All right. So let's take a look at an example. So over here, you can see that this pair on the chart is a Euro USD. Okay. And say we believe that the Euro USD is going up. Okay, so when we say the Euro USD is going up, it means that the Euro is appreciating against the dollar. Or we say the dollar is depreciating against the Euro. So when we buy Euro USD, we are bullish on the Euro. We think the Euro is going up, and we think the dollar, the US dollar, is going down. So we go long on the Euro US dollar. Make sense? okay? And say we go long at 3510, okay? And we buy one lot. We buy 100,000 of the base currency, which is 100,000 euros. So we key in one lot into the broker, and we're in the trade. And say we are right, and it goes to 3550, and we sell. So how many pips did we capture? We captured 40 pips, right? Because 3550 minus 3510 is 40 pips. And we bought one standard lot, so times 1. If you bought 2 lots, times 2. If you bought half a lot, times 0.5. Make sense? And we multiplied by the dollar value per pip. And the dollar value per pip for Euro USD, which you saw on the table, is $10, right? So 40 pips times $10 times one lot is $400, right? So in this case, you made $400. Okay, again, that is the dollar value per pip per standard lot. Okay, so let me explain the same thing in a linear form. Some people like to think linear. So again, I go long on Euro USD, one standard lot at 3510. Okay, so again, I buy Euro USD at 3510 and I sell Euro USD at 3550. So the difference is 40 pips. Okay, and again, the profits is the number of pips times the dollar value per pip times number of lots. So we've got 40 pips times 10 bucks times one lot, that's $400. Okay. So another way of looking at it is that I'm buying 100,000 euros and paying $135,100. Okay. I'm buying 100,000 euros and paying 135,100 for those 100,000 euros. And then I sell 100,000 euros over here and receive $135,500, right? As you can see over here. So the profit earned is this and this. So this plus this minus this is $400. Okay. So notice that if you don't use leverage, right, you would have to invest $135,100 or 100,000 euros to earn $400 US, right? So in other words, you're earning $400 US dollars from $135,100. That's a 0.29% return. You may say, that's such a small return. You're not going to buy 135,000 US dollars to make $4. Are you nuts? Okay. That is why in Forex, all Forex traders use leverage. Because if you don't use leverage, it doesn't make sense. Because currencies move very little every day. So for us, we're going to be day traders. We're going to buy and sell on the same day. All right. So to make it worth our while, to have a good return, right, we need to use leverage. In other words, we don't want to put down 100,000 euros in order to make a lousy $4. We want to put in a small deposit in order to buy the 100,000 euros so that the profit over our deposit is a good return. Okay, so most Forex brokers allow you to leverage 1:100. What does that mean? That means for every 100,000 euros, you only need 1,000 euros of deposit to buy that position. Okay, so if you only use 1,000 euros, okay, that means you're making $400 from 1,000 euros, and that's a much better return. Okay, but I can tell you that for us, or for me at least, when I trade Forex, I don't ever use more than 1:20 leverage. Okay, so again, brokers allow you to leverage 1:100, but for the purpose of trading, we will not be leveraging any more than 1:20. Okay, so in other words, for every 10,000 you put into your account as capital, you don't have to buy more than 200,000 worth of any currency. Very rarely, right? Usually, I only leverage about 10 to 15 times. So for every 10,000 I put in, I'm only buying 100,000 worth or 150,000 worth of currency. Okay, so again, if you employ a leverage of 1:20, we just need to invest a margin. Margin means deposit of 6755, right? Or rather 5% of the position size. So our return in this case becomes $400 profit over 6755, which is a deposit you need to buy 135,000 dollars, and that's a 5.9% return per trade, which is a lot better, right? So let's look at the opposite scenario, which is going short. So in this case, we believe the Euro USD is going down, all right? Or the Euro is depreciating against the dollar. Okay, so we want to go short, and we short Euro USD at 3560. We short one standard contract, one lot, which is 100,000 euros. All right, and say we are right, it goes down, and we then buy it back at 3520. Okay, so how many pips do we earn? Okay, so notice in the forex markets, okay, there are two ways to make money. One way to make money is buy low, sell high, right? Which is what we did in the previous example. The other way to make money is to sell high and buy low, right? So it's the same thing, just going the opposite direction. You make the same profits, okay? So in this case, we sell at 3560, we buy at 3520, and we made 40 pips. Okay, we made 40 pips. The difference between 3560 minus 3520. 40 pips, we made 40 pips, and each pip is $10. We bought one lot, that's $400. So same thing. So again, let me re-explain in linear form. Going short, Euro USD, one standard contract. And so we sold Euro USD at 3560. And we bought it back at 3520. Difference, 40 pips. Okay? So again, what's your total profits? Number of pips, which is 40, multiplied by the dollar value per pip, which is $10 for this pair, multiplied by one lot, which we bought one lot. Okay, if you bought two lots, we times two. Okay, so we get 400 US dollars. So again, another way of looking at it is that we started by selling 100,000 euros. Okay, and received $135,600. Okay, and then we bought 100,000 euros and paid $135,200. So we bought 100,000 euros and paid this amount, of which we had this amount already. Okay, so the total profit earned will be the difference between this and this, $400. All right, so we made $400. So again, without leverage, notice that you would have to utilize $135,000 to earn $400, and the return 400 over 135 grand, it's 0.29% return. All right, so hardly worth our while. Okay, so we use leverage. So instead of putting down 135 grand, if we use leverage of 1:20, that means we only have to put a 5% deposit or 5% margin in order to take this position. Okay, right? So 5% of 135 grand is $6,000. So if $6,000, we can buy this position, or rather sell it and buy it back, and we're making $400. So $400 over, oops, it's too fast. $400 over, let's go back to that. Right, $400 over 6 grand, it's 5.9% return for one trade that takes 1 to 2 hours. Pretty good return, right? So leverage is what makes, what allows us to get a really good return on our trades. Okay, so again, let me just talk a bit more about leverage. Again, in Forex, most brokers will allow traders to leverage 1:100 times. Okay, so that means you can buy or sell 100,000 US dollars worth of currency with just $1,000 in your account. But in most trading situations, we usually only leverage 1:20. Okay, so this means that with a $10,000 account, we usually will buy or sell up to 200,000 worth of the currency at the very most. And that is all that's required to achieve exceptionally high returns consistently. Okay, so notice that based on the leverage, it tells you the margin required. Okay, so again, 1:20 means that we just put a 5% deposit or 5% of the contract size to go long or short on the position. Right, so that's how we use leverage. All right, so let's talk about the different kind of Forex traders. So just like there are so many ways to cook fish, there's so many ways to trade Forex. And there's no the way, there's no the right way. There are many ways. And you can be really successful and really profitable in many different ways. So it all depends on choosing a style of trading that you're comfortable with, that suits your personality, and that fits in with, again, your work schedule or your time schedule, all right? So there are basically four kinds of Forex traders. And let me begin with the long term, and then I'm going to go down to the short term, right? So some people are what we call position traders. In other words, they will enter the Forex position and they will hold it for a couple of months or even years, right? They have a long-term view. And normally these people, they will tend to trade based on looking at fundamentals, right? The underlying health of the economy, what's happening to interest rates and GDP, and they look at the overall big trend. So normally position traders like George Soros, for example, when he enters a trade, he will target 500 to 1,000 pips per trade or more, right? So to capture 500 to 1,000 pips, you have to stay in the trade for a few weeks to months to even years, right? And position traders, they tend to look at the charts and they look at daily candles, right? So each candle represents one day, or they look at weekly candles. So those are position traders, okay? Next, we have swing traders. So swing traders will typically target 50 pips to about 150 pips per trade. So when they get in, they hit 50, 150, they're out of the trade. And the trade duration usually lasts for less than a week, a couple of days, right? And they'll look at charts with hourly or 4-hourly candles. So those are swing traders. Next, you've got day traders. And day traders, as the name implies, they buy and sell within the day, right? The trade rarely passes over the next day, right? By the end of the day, they close the trade. And so normally, day traders would do a couple of trades a day, right? Maybe 2-3 trades a day. Where swing traders, right, it takes about a couple of days to close the trade, right? So they may not take as many trades. And position traders will take even less trades because their one trade lasts for a few months or even weeks or years, okay? Day traders would look at charts and analyze based on 15-minute candles or 1-hour candles or 4-hour candles. Now, the shortest time frame that people trade are, well, we call them scalpers, right? They scalp the market. So scalpers, usually they enter and exit within a few seconds. So they buy, boom, they sell, all right? And they just target 5 to 10 pips. They're out of the trade. And they look at 1-minute and 5-minute candles, right? So again, you've got successful traders in all four categories. My personal preference that has worked for me where I make the most money consistently is, that's right, I'm a day trader, right? So I usually take anywhere from 1 to a maximum of 3 trades a day, no more than that, right? Because if I take an average of 2 trades a day, which I do, in a month, you're doing about 40 trades, and that's more than enough. 40 trades a month, it's more than enough, okay? And again, my usual target is, like it implies, 20 to 40 pips per trade, and I tend to trade on 15-minute candles. So each candle is a 15-minute time frame. So that is my personal style. So let me show you the charts and show you how this kind of looks like on the charts itself. Alright, so let me show you an example of the different kind of trading styles with the charts, okay? So what I'm using is the MT4 platform, which is the trading platform that most traders use. And most Forex brokers use the same MT4 platform. And in the lesson on technical analysis, you're going to be learning exactly how do you set up the platform, how do you use all the charting software. But for now, I'm just going to show you some basics of how we trade in the different styles, right? So I'm looking at the Euro USD, okay, and the market's closed right now. I'm doing this on a weekend, so you can see that the prices are not moving, but when the market's open, you can see the prices will be moving rapidly, okay. Um, Now, what I've selected is D1, which means daily candles, right? Which means each candle represents one day. So that's 1 day, 2 days, 3 days, 4 days, 5 days, so on and so forth. And you can see these red and green candles. The green candles represent bullish candles, which means the price closed higher than the open, and bearish candles where the price closed lower than the open. And again, you'll be learning candlestick patterns in detail under the lesson on technical analysis. So right now, I just want to show you that for position traders, okay, who are long-term traders, they look at daily candles, right? And so what happens is, for example, they may see an uptrend and say, okay, I want to enter the trend. So for example, you can see this is a very clear uptrend over here, all right? And they may say, okay, I want to buy here, right? Buy the Euro USD, and maybe I want to sell it somewhere here, for example, okay? So how long is this, right? So this April, right? April, May, June, July, August, right? April, May, June, July. So it's 5 months, right? So the whole one trade for 5 months before they exit. This is a position trader. To me, it's really long term. And how many pips is that? Well, let's take a look. If you click on this crosshair, okay, and you click on this and you drag. Now, do you notice you can see these numbers? Can you see this 4376? Can you see that? If you drag 4638, 513, can you see that? Okay, so those are the number of pips. Number of pips. So in other words, if you were to buy from here, okay, from here, and you were to sell it here, how many pips is that? That is 6131. Can you see that? Now, 6131 can see is 4 decimal places. Okay? But in this case, the 1 is a fractional pip. So you ignore the 1. You take 613. So this means it's 613 pips. 613 pips. Okay? So which means that if you were to buy here, all the way, and you sell it there, how many pips is that? That is 1,357 pips, right? Because the 3 at the end, 13573, ignore the 3 because that is a fractional pip. So again, 1357, that's 1,357 pips. So you can see that for a long-term a position trader, right, they are in it to capture 1,000 pips, 500 pips, 2,000 pips. Okay, so to do that, you have to be in a trade for a couple of months. Okay, so that's position trading. So that's not my style, right? You can do that if you want to. That's not my style. Next would be I mentioned swing trading, right? So swing trading is, again, you tend to look at hourly candles as a swing trader. So when you click H1, it's hourly candles. So now it's kind of like we're taking a microscope. We are zooming in such that now each candle that you see is 1 hour. So it's a 1 hour candle, 1 hour. So each candle takes 1 hour to form. Okay. So as a swing trader, okay, you can look at the hourly candles, 1 hour or 4 hour candles. 4 hour candles, right? Where each candle represents 4 hours. So for a swing trader, they may take a slightly longer trade, okay? For swing trader, they may, for example, trade from here. I can see an uptrend. You can see this uptrend here, right? And then this consolidation going sideways. So they may take a trade. For example, they may buy somewhere here, okay, and yeah, they may maybe sell Let me take a look. 3, 5. Yeah, in fact, shorter than that. So for swing trader, let me zoom in a bit. Okay, so they may buy somewhere over there, and they may even sell just there. Okay, so they captured about 100. Okay, you can see 1315 at the center. So that's 131 pips. All right, so they captured 131 pips. They're out of the trade. And again, from here to there, they buy and sell there. It took a couple of days from the 5th of July to about the 11th of July. Right, so that's about 5 days, 6 days. Right, so that's a swing trader. Right, so the trade lasts for a few days. Okay, they look at 4-hour, 1-hour candles. Okay. Next, so let's go down. We have got position trading, we've got swing trading, and next we day trading, right? Which is what I do. So I'm a day trader, and as a day trader, I tend to use 15-minute candles, right? 15-minute candles. So now it's like I take a microscope, I zoom in even further down, and each of these candles you see over here, okay, these are 15-minute candles. So each candle represents 15 minutes, 15 minutes, 15 minutes, right? So as a day trader, I will usually go for 20 or 30 pips, and I'm out. All right. So I could, for example, again, you notice that there's a nice trend here going up, trend going down, right? So reverses up, and I could take a trade here somewhere. For example, I'll teach you again on the lesson on the strategy, right? The impulse pullback, impulse pin bar. I'll tell you exactly when to get in based on the moving averages, support resistance, candlestick patterns. So I'm not showing you the exact strategy right now. I don't want to confuse you. I'm just showing you, how many pips we capture, right? So I could enter here, for example, as a day trader, and I capture something like about there, right? You can see 242 at the center. So that's 24 pips, right? So, I buy somewhere here, all right? I buy somewhere here, oops, buy somewhere here, and there I'll sell somewhere here, all right? So I buy here, I sell there, I get 24 pips. That's it, I'm out. And I go for the next trade, I may buy here and sell there, all right? So I'm capturing the very short-term trends within the day. So you can see that this trade from here to here was within the same day, within the 3rd of October. So how long did this trade take? It took 1, 2, 3, 4, right? One candle is 15 minutes, right? So 4 candles is 1 hour. So 1, 2, 3, 4, that's 1 hour. 1, 2, 3, 4, 2 hours. 1, 2, 3, half an hour, right? So this trade lasts for about 2.5 hours. That's it, and I'm out of the trade. So this is day trading, right? And finally, you've got scalping. And scalping I don't do because it's too fast-paced for me, right? It's too stressful, right? I don't like to be a scalper. But scalpers, they may use 1-minute candles or 5-minute candles, right? So they may use a 1-minute candle, and it's kind of like you zoom in even further with a microscope, all right? And you can see that each of these candles are 1 minute, right? They take 1 minute to form, and the scalper may buy here, right? They may say, hey, okay, there's this sideways, the trend going up, right? So they buy here, and they get maybe like 10 pips. I can see 103, right, in the center, so that's 10 pips. So they buy here, they get 10 pips, boom, they're out, they sell, right? And they get in again, they sell again, they get in again, stuff. Really stressful. You can do a lot of trades a day. Not my style, right? So again, I'm a day trader, and hope this gives you a better understanding of the different kind of traders. Okay, so let's move on to the next part. All right, so let's run through the entire trading course curriculum. And you should be able to finish this course within a week. You can look at 1 lesson a day and then practice it. That'll be ideal, that'll be optimal, right? And do practice it as you learn. So lesson 1, we have just coming to the end of lesson 1, where it's the introduction to Forex trading. I do hope now you've got a pretty good understanding of what Forex is all about and how we trade it. Okay? Lesson 2 will be going to next, where you're going to learn the secret to achieving consistent trading profits. And it's based on statistics, based on mathematics, right? You'll be learning the statistics of, again, consistent profits, how to achieve consistent profits from random outcomes. All right. In a short run, price movement is pretty random, but there are repeatable patterns that we exploit in the markets to create consistent profits over a number of trades. You'll be learning exactly how to trade just like a casino. You know, the casino is playing a game of chance with the players, but the casino always wins at the end of the day because they've got an edge over the players mathematically. You will learn the principle of how casinos do it and implement it into your trading routine. And how do you develop a trading system with a positive expectancy in the markets. Next, in lesson 3, we're going to technical analysis, which is the main tool I use to get an edge in the markets, to anticipate price movements. You'll be learning about the foundational principles of TA. We'll cover candlestick patterns, how do you identify trends, how to utilize support and resistance levels, how to master moving averages, and how to use the trading platform. And we're going to be using the MT4 platform, which is the most common platform used by traders. Okay, lesson 4. Lesson 4 is all about position sizing, risk management. How do you manage your money and size your positions? How many units do you buy? How many contracts do you trade? And how do you automate your trading business with order management techniques? So your entries and exits are automated. You don't have to be there. Takes your emotions out of the equation. Okay. Lesson 5 and lesson 5 will be the first lesson where you'll be learning the actual strategy, where we put everything together into a system. Okay, a system that will generate consistent profits. And the first strategy you will learn is the impulse pullback strategy. Okay, so you'll be learning about specific price action patterns you'll be using for this strategy, entry and exit rules for long setups and short setups. How do we filter to take only the highest quality trades, and how do you manage your trade, right? How do you exit the trade? How do you enter the trade with precision? Okay. Lesson 6, really important, psychology of winning traders. So how do winning traders think differently from the herd? How do you manage to overcome negative emotions that will impede your progress as a trader, that can sabotage you? Okay. How do you manage temporary drawdowns in your capital, which is inevitable in trading? And how do you program your mind to become a winning trader? Okay, so in lesson 7, you'll be learning the next strategy, which is the impulse pin bar strategy. This is another very powerful strategy that I use with really high win rates and expected profits. Okay, you'll be learning about the bullish and bearish pin bar and specific price action patterns that work with this strategy, exact entry and exit rules for long and short setups, how do you filter for the highest quality trades, and again, trade management and exit strategies. Finally, to cap it all off, lesson 8, developing a trading plan. Just like any business needs a business plan, as a trader, as a professional trader, you need a trading plan to guide you. So you'll be learning how to develop such a trading plan, and you'll be learning about my daily trading routine that takes 3 to 6 hours a day, or even less. Okay? How do you keep a trading journal to record your progress and to keep improving with each and every day? And we'll also talk about how do you choose a Forex broker with really tight spreads, no commissions, that can really help you in your trading journey. Okay, so that concludes lesson 1, and I'll see you guys in the next lesson. To revise what you've learned. If you've got questions, send me an email. I'll be happy to help. This is Adam Koo signing off, and I'll see you in the next lesson.